Welcome, everybody. Super grateful to have people here in the room today. Again, joining the Meaningful Ideas Trading Club. This week, we thought we'd talk about some real basics of investing and mindset of investing and things of that nature. I asked Ben Nesvold to join us today to speak on some of those issues. So Ben, you inspire me, and I let you talk here about yourself, what you do, where you are, because I have this philosophy about deciding and then doing, and a lot of people struggle with the decision, and their indecisiveness kind of keeps them in a place, and then they never do anything, right? So you were at kind of a critical point as a young guy, young man, and you were headed down a different industry and made a choice and went in a different direction, right?
Right.
Right. Take us there.
So I'll start with how I actually know Kyle and the Hawley and Kaufman Keltzer group here. I started working for Hawley, Kaufman and Keltzer in high school and was tracking down the legal career path for a long time before deciding to go a different way. And I actually moved from Madison, Wisconsin to Charleston, South Carolina, a little over 2 years ago now, to pursue a career in finance and specifically financial advising, helping people that are going to talk about invest and managing their finances and organizing their protection plan and making sure they have partnering with attorneys and estate planners to make sure they have wills in place. But Kyle, you're right. Analysis paralysis is a real thing. And sometimes we just have to find what we're passionate about and pursue it. And that's what I decided to do 3 years ago.
And tough, man, because can I talk about you were in law school and then decided I'm out, I'm going somewhere else. That's hard, right? The most important thing, you felt good about that decision for yourself, and I just commend you for that. So investing, tell us some things that you do, and I just want to use this as a launching point. I just think it's so important for people at any point in their life to start thinking more consciously about their money, thinking about what to do with it. And essentially, my goal of this is for people to be motivated to become more financially literate.
Right. The essence of what I do and what it really boils down to for me is our wealth gives us the ability to experience life. So whatever we want to put our money towards is kind of the things that we want to experience in life, whether that's leave a large legacy for our children, enjoy our retirement on the beach, or build a business. It really depends on what you want to do. And that's what I help people figure out and then point them in the direction. Most of us, when we think of investing, we think of our 401k. But when we talk about investing and we talk about 401ks and we talk about things like that, what we're really talking about is the stock market. And the stock market, I think, is a sometimes misunderstood term that's thrown around in the media as something either we love or we hate. But what it really is it tracks companies. It tracks companies' earnings, and it is made up of a large basket of companies. So the S&P, which you hear a lot about, is a basket of companies: Apple, Microsoft, Amazon, Walmart, household names. And I want everyone to understand that when we talk about saving and we talk about investing, they're two very different things. Saving is what I think about for emergency purposes. You want to have, on average, somewhere between 3 and 6 months of living expenses. And as you get older, maybe a year, 2 years worth of living expenses in savings and in cash. But when we think about investing for the long term, you want to put your money in things that grow. And companies in the stock market is historically something that has grown.
It's kind of fun to say hey, I have some ownership in a big blue chip company, right? To me, the concept of whether you spend $4 or $5 at Starbucks versus if you start accumulating some, whether it's through a mutual fund or you buy the stock individually, I guess, right? Some ownership interest, and it kind of is fun.
But yes, exactly. It is an ownership in an equity that appreciates in value over time. And when I think about investing, I always tell clients, invest early and invest often. The $1 million mark is what everyone always wants to have when they get to retirement age. How much money do you want? I want $1 million. Well, to get to $1 million, it just takes time in the market, not timing the market. So if you want $1 million to start saving, you need to put aside about $400 a month beginning at the age of 25. And the reason I say invest early and invest often, if you wait until you're 40 to have $1 million by the time you're 65, you need to put in over $1,200 a month versus starting early and starting often. I've noticed it, and I tell clients this a lot that are having children and have young children, to talk about money openly and honestly with your children, because it's one of the most important things they're going to deal with in their life is navigating finance, personal finance, debt, credit, buying a home, paying off debt, retiring. So you're right. It is a relationship, and some people have a healthy relationship, and others, buried deep down in their closet and don't like to talk about it. Sometimes like our feelings.
So, the relationship with money is like, in a way, just like a relationship, with family, friends. It's designed to be fun. It's going to ebb and flow, right? Like when we look at that, the traditional stock market and going up and down, my thought is you just have to stay steady and essentially have faith that the history tells us that over time, like you're saying, the more you invest into it in time and in the effort on a continual basis, it'll all even out and work out in the end.
Yeah, and I have an interesting graphic to show that, Kyle. So this is what the stock market looks like on a monthly basis. If you looked at the returns of the stock market every month, this kind of looks like a polygraph. It's up and down and up and down, and every month it would look like this if you checked your account every month. But if you left it, and this is what it looks like over time, that's what it looks like from a big picture view. And so that's when we say invest early and often. Those dips, you feel them in the moment, and you're told to panic and you want to worry. But over time, companies produce goods for consumers like you and I that continually improve and continually make better and grow their profits.
So for the people here that would say, well, that's great, but it's going to take me until I'm like, 60 years old, like to actually enjoy that, like in a retirement plan. So Ben, what do you think about that kind of dual, right, long-term goal, and then the shorter term to, like, I don't know, have some more fun with it, like, so you're not just like, it's just waiting until I'm 67 years old?
No, absolutely. It's honestly, and when it goes back to what I spoke to earlier about wealth, being the ability to experience life, and a lot of people want, and I had this conversation last week, they want to be able to go on vacations with their kids now rather than pinch pennies to retire comfortably 30 years from now. And a lot of things we can do is the number one thing I can say is live below your means, not within your means. Instead of trying to be something that you're not, you can try to increase your cash flow by getting a side gig, or maximize your time by leveraging other revenue streams is the big thing. So passive investments like rental property, investing time in your education and your career can really help you maximize your cash flow today versus just getting by and setting money aside for tomorrow.
So the time that you're referring to is really like, the idea of like, don't time the stock market, just do it now, right?
Yeah, getting started is the hardest part. We always, like you were saying earlier, we always overanalyze, and that causes paralysis. Is now the best time to start doing this or that? And when it comes to the stock market, I'm almost 30 years old. I'll be 30 here in a year. If you're thinking, I don't want to invest in the stock market for my retirement, well, it's never been lower over a 10-year period or 20-year period. So I think just getting started is the hardest part. And once you dip your toes in, you realize how rewarding and how actually fun it can be.
Do you see a lot of like people come in with like myths or beliefs that are just like not accurate? Do you see any of that ever?
Oh yeah. We all have certain events in our lives that have had an impact on us, and we all hear certain things from different outlets or people that aren't necessarily true in the long run or in the big picture. And part of this job is psychology as well. I'm a big fan of behavioral economics. And the reason people are so scared to invest is you feel the pain of losing $1 3 times more than you enjoy making $1. So if you make $1, you're happy. If you lose $1, you are depressed. So a lot of that goes into just the behavioral side of things, of keeping people in check.
So my wife and I did an experiment a couple of years ago where, in addition to the retirement planning, because I wanted to have a little bit more control, Katie, and I wanted to know, and my wife did, like, hey, how are people doing this in the market? Robinhood was fairly new then. There were some other accounts. And I had always been interested in index funds. I had heard about that for a number of years. And again, didn't make a decision to do anything about it. So waited and waited and waited. So we experimented. We took $1,500. We put it in Vanguard in an index fund, and we put $1,500 in Robinhood. And what we were trying to do there is to see if we then made continual investments, like bi-weekly or weekly, into each account, which one would kind of have more success. So what I'm always told about stock picking and Warren Buffett, right, like the greatest investor of all time, which he would, Ben is speaking to what Warren Buffett says, like, put your money in, buy stuff that you like, and just hold it essentially, and let time allow it to grow. Don't try to just pick stocks unless you have a lot of time to do it. Okay. And what I found is when I was doing the Robinhood, I would get these emotional reactions, right? Which is exactly what you're not supposed to have. And so, I went in with a philosophy of, hey, I think humans like communication, transportation, and things that make their life easier, right? So that was my criteria in finding companies. And then my wife had a great idea about medical and the need for medical advancements. So we purchased some individual stocks, and it was like a scary thing. It was like, oh my God, we're going to lose all this money. We're going to lose all this money. And then guess what happened? It was like one of the stocks I picked was Facebook, and it had like the next day was like one of its worst days ever. I was like, oh my gosh, I made such a mistake. I'm going to be, and some of the other ones went down. I had these emotional reactions to it and had to calm myself down and let it all play out. Now those prices have gone way up. Okay. But the stock picking for me wasn't real good. I still have a Robinhood account, and put money into some individual investments there. But that one has not performed as well as that index fund, which got to a point where it became a point where I couldn't manage it any longer, and I turned it over to somebody else because that was the right thing to do, because it was just becoming something that needed more attention than I could give it. So long story there, but if you want to open an account at Robinhood, it's super simple. You need zero money. You need a bank account. Just Google open Robinhood account, and you'll find a link directly to it, and you can go in there. The good thing about it's designed for consumers to go in and look at and have easy use and to look at stocks. And they also allow for fractional ownership. So, as Ben was talking about, if you have like literally pennies, you can invest in companies, or dollars. You don't have to own an entire stock. Ben, you talked about employee matches. If you work for somebody, right, and they offer you a program, what should you do about that?
When you're getting started with investing and you start with an employer that offers some type of employee contribution plan, whether it's a 401k, a 403b, a 457, a simple IRA, the first place you want to start saving is at least achieve your employer's match. If they offer a 3% match, put aside 3%, because you're losing out on free money. You're losing out on an equal dollar for dollar contribution to your future. You may think, oh, I can't afford 5% of my paycheck. Well, they're giving you an additional 5%. They're doubling your money almost instantly. So when you're talking about starting for retirement and that long-term savings goal, at least get the money that's on the table to start off right away.
Okay, guys, that's the Meaningful Ideas Trading Club for this week, August 12th, 2021. Ben, thank you so much for being here, and anyone else watching live on Facebook today, and for all you folks that came into the room and contributed. And we'll see you next week, all right?
Thanks, Kyle.
You're welcome, my friend. Thank you for being here.